Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. A strong showing so far for stocks. Investors digesting new earnings reports, fresh economic data, while monitoring the next move in President Trump's campaign to oust Fed Reserve Chair Jerome Powell. Now I want to welcome in here, we got Caleb Silver, editor-in-chief at Investopedia, Joe Brusuelas, who is chief economist at the firm RSM, and our very own markets and data editor, that would be Jared Blickery, all here throughout the show to help break down these headlines. Jared, we're going to start with you, kicking things off with how you get to look at the deeper moves in today's markets, Jared.
Yes, we are in rally mode right now, and this started at 8:30 a.m. We got a pivot off of that retail sales announcement. This was an hour before the market opened. Here we're looking at the Dow Industrials up 282 points, and we are right near the highs of the day and the afternoon right here. Here's the NASDAQ set for a record close, notched an intraday record, and it has just been holding steady with about 0.8% of gains throughout the afternoon. And the S&P 500, here you go, up over 0.5%, also set for a record high. And we got to check in on the small caps. Russell 2000 up 1%, so that is up greater than any of the major indices we were just looking at. And I want to turn to the bond market as well, because I've had my eye on the 30-year bond yield. That is down just a smidge, but still holding above that critical 5% price or yield level right there. And then we have the US dollar, which has been trending up, and it's up another 0.33% today. And taking a look at the sector action, much like yesterday, we only have one sector in the red, except XLV, that's healthcare right here. This is down 1%. That was the leader yesterday. But today the leader is financials, and then after that we have industrials and tech. Each of those up more than 0.9%. Each of those set for a record high as well. After that, we have staples and materials, all of those outperforming the S&P 500 right here. And let us check in on the NASDAQ 100. We can see the mega caps getting some love here. Not Meta and Tesla, but Nvidia up another 1.2%. Good for another record high, it should be. Microsoft up 1%. And we're seeing some broad strength in the tech sphere. If I take a look at the semis and also the software sector, we're going to see a lot of these big names in the green, some of the smaller ones as well. Here's software. You can see Shopify up 5%, Oracle up almost 3%. And also, let us check out the Dow, because we are seeing broad-based strength here. Couple of sore spots, that would be healthcare. United Health down over 1%. Looks like Amgen, Merck also down, but for the most part, we're seeing a lot of strength in these blue chip names. We can also take a look at the transports, and some of the bigger ones falling today. UNP down 1.5%, Uber and UPS in the red, but we have United Airlines, that's up 4.5% after some positive earnings yesterday afternoon. CSX, that's a railroad, that's up 3%, and the list goes on. I do want to show you some of the banking earnings right now, or not, the banking heat map, reflecting some of the earnings that we've seen this week. You can see mostly a green board. JP Morgan up 1.5%, Bank of America up 2%, Citigroup up 3%, and I'll send it back to you, Josh, on that.
All right, thank you, Jared. Caleb, I want to get you in here as well, because as Jared was pointing out here, we got green across the screen today. What do you make of these market moves?
Yeah, are you not entertained? Record highs usually beget more record highs, and that's kind of in the trend we're in right now. The economy seems to be holding up just fine. If you look at the retail sales numbers, if you look at the labor report from a couple of weeks ago, if you look at the inflation report, nothing shocking there, more smoke than fire when it comes to tariffs. And investors are looking way beyond that. What are they looking at? Improving corporate earnings. They weren't going to be as hot as they were in past quarters, but they're actually better than we thought they would be. Funny how that always works out. We've got 88% of the companies so far beating earnings that have reported. Only 50 companies have reported, but some big ones, namely the banks. So you got relatively strong retail sales. Was that a pull forward in advance of potential tariffs on August 1st? Doesn't really matter as long as retail sales aren't falling. There are jobs out there for people and prices aren't spiking that much. That's all good news for investors.
Joe, as the resident economist on the show today, let's get your take on this, because as Caleb was pointing out, listen, Joe, retail sales, they rose more than expected in June. You got U.S. jobless claims fell. What do you make of it, Joe? What do you think the Fed makes of it?
Well, I think that the economy is very dynamic and resilient. Your mileage may vary depending on what sector you worked in, but it looks to me as if the economy through the first half of the year is going to come in around that 1 to 1.5% growth path. Not quite what we want to see. Did like those retail sales earnings today. Quite strong across the board. Good rebound after a big decline in the previous month. But, you know, I tend to look more at the yields and Forex. Bond market's not quite as impressed equity investors are. So we're going to have something of a split decision. I think by 1 o'clock Eastern, we only had about 450 million shares traded. So very light volume day. And many days we get real strong momentum on the close. It could be over $500 million. So we'll want to see how that shapes, how that shapes up as we head into the close. But for now, look, we've got a resilient economy. It's absorbing the blows from the rising inflation that's just started to show up.
And Joe, while I have you, I want to get your take on another story we've been talking a lot about, and that was this back and forth, Joe, between Trump and Powell. Trump did say, listen, he's not planning on firing Powell, but a lot of hot talk there, and I'm just curious what you made of it, Joe.
So I don't think eroding the credibility or the independence of the central bank is an optimal policy path for anybody. As a matter of fact, one gets the sense that this just hasn't been well thought through strategically or tactically over at the White House. One sure way to lose control at the end of the curve and to get rates to move up is to try to fire the Federal Reserve chairman. I just think that central bank independence has served the American economy exceptionally well, and that this is the bad idea of all bad ideas.
And Jared, Joe brings up the point here. I mean, we assume and we expect Fed independence. Maybe just walk us through here. What do we mean by that, and why is that so important?
Well, we wanted an independent Fed that's not going to be controlled by Congress. With a congressional mandate is to control the purse strings of America, to control that fiscal policy. You want to have independent monetary policy because that has different aims. We have maximum employment. We also have stable prices, which the Fed interprets to mean a 2% price target on that inflation target. Those can be operated independently of Congress. You merge those two, and suddenly the wheels can come off. And I'll tell you one thing. I'm going to go back to this chart of the 30-year yield because I was watching this as like a hawk yesterday as the drama was unfolding, and I'm going to go into deeper depth with this in the next hour. But let me just show you a 2-day chart of the 30-year. And here is yesterday when we had some of these fireworks and we saw the yield shoot up there. Now, that was the turning point in the dialogue. That we had the New York Times story that they had a letter that President Trump was going to send to Jerome Powell, to the Federal Reserve. And then right as yields were popping above 5% and we saw stocks decline at that moment, that was when we saw the Trump walk back. So my thesis is I think Trump is paying attention to the bond market, and I think that's a good thing because we do need that Fed independence, and so we might have at least a little reprieve on that for the time being.
And Caleb, do you think Trump?
Josh,
I'm sorry. Go ahead, Joe. Go ahead, please.
The reason why the Fed has independence is that we don't want political actors making short-term decisions in their own electoral interest that result in higher inflation and lower living standards over the medium to long term. That's why we don't allow Congress or the executive branch to set interest rate policy, because everywhere else where they don't have central bank independence, that's exactly what happens.
And Caleb, let me come to you. Do you think that Trump, ultimately, Caleb, does he actually get what he wants this year, regardless of the Powell drama? Do we see a cut?
He wants lower interest rates because he wants to lower the interest payments we make on our debt. Those are somewhere around $888 billion a year. You lower interest rates, that number goes down by maybe a couple hundred billion, maybe $100 billion, which then the Trump administration can use for whatever it wants or to offset the pain from tariffs. So that's the main reason he wants lower interest rates. Also, lower interest rates spur more buying by consumers and by businesses, and that could lead to higher stock prices if it leads to higher profits. But it really, at the heart of the matter here is the interest payments on the debt. That's aggressive. That takes money away from where they want to spend money. You ultimately get a couple of baby cuts by the end of the year, and even if he replaces Powell, it doesn't necessarily guarantee that the FOMC, which is made up of 12 members of the Federal Reserve, are going to vote to lower rates. It's not as if Fed Chair Powell is making the decision himself. It's pretty short-sighted to think that it's just him.
And Alexis, you've also been following the Trump-Powell headlines. Give us your take. What do you make of it?
Yeah, so look, we are looking at the independence of the Federal Reserve, but by law, Congress made the Federal Reserve's Board of Governors independent of the executive branch. So that's in the Federal Reserve Act of 1913, which created the agency, and it's in the Banking Act of 1935 that amends it. And like with other agencies, Congress has tried to enhance the Federal Reserve's independence by blocking the president from firing its members, except if the termination is, quote, for cause. But the problem here is that phrase has been left in the statutes undefined. And so where does that leave us? It leaves us at the courts to have to interpret it. So there is one Supreme Court case from 1935 that took up the issue, not for the Federal Reserve or for the chair, but for the also independent Federal Trade Commission chair. Now, that official challenged President Roosevelt's decision to fire him over political differences, 100% political differences. But the court said that wasn't going to be reason enough, and instead it stuck by the language in the FTC law. And what it said was that the chair could be fired only for things like neglect or malfeasance. Still, though, the Trump administration has been testing the bounds of executive power to fire so-called independent agency officials. The Supreme Court, in fact, got involved in one such case so far. It was in an emergency request from the White House, and the Supreme Court allowed the terminations of the officials at the NLRB and MSPB to stay in place while the dispute plays out in the lower courts. But when the Supreme Court granted this pause, they also said that the administration would likely be able to show that these agencies exercise what they called considerable executive power. So the president has fired other independent agency officials, as we've seen play out. They're also challenging these terminations in court. But Josh, by and large, just another test here of executive power. Could it go to the Supreme Court? Possibly. We also have to look at the end of Jerome Powell's term coming up in, May 2026. So a lot of the legal experts that I talk with say we think he'll just wait it out.
Joe, here's an idea. I just want to bounce this off you. I know, Joe, that Trump pounds the table. He wants cuts. What about, Joe, maybe Trump actually is okay if Powell doesn't cut? And if the economy, Joe, were to go wobbly, he could then say, well, listen, I said, what did I say? Too late, Powell. He didn't listen. Now look what you got.
No, that's a good description of what almost surely would happen in that case. But look, that's a political concern. We're not really concerned here around the politics or the optics of this. What I'm concerned is that Caleb made a very strong case of exactly why we've given the Fed independence. Because if we move down the road that Caleb outlined, you're going to get higher inflation on the back of this. We already are going to have an extraordinarily difficult time getting the target back to 2%. My forecast is the PCE is going to go to 3% in the near term, likely higher, the CPI 3.5% with risk of 4%. It's going to be a substantial period of time, if ever, that we get the inflation target back to 2%. And guys, take a look at what the difference is if the inflation rate's 2% versus 4%. You've got a real direct decline in the standard of living, which is why I know you guys out there who are watching today really only care about equity prices. That's really not what's important here. It's that rate of inflation, making sure the central bank retains control of the long end of the curve. And if the 10-year moves above 4.5% and the 5-year makes an assault on 5.3 to 5.5, as I think it's going to here in the near term, equity prices are going to pay the part. Equity prices are going to bear the cost of that.
Joe, I want to get your take on something else, which is as we study these tariffs and we try to think through where they fall on the value chain, ultimately, Joe, when you listen to the Trump administration, those officials, what they seem to be arguing, Joe, is their bet that that's going to ultimately fall on foreign producers. That's who's going to take the hit. That's who's going to take the margin hit, more than Joe, more than Josh. What do you say to that?
Okay, so they say that on one hand, and then on the other, they brag about increased tax revenues. Who's paying that? Now tell me, guys, quick quiz for everybody here, right? The goods come in, they arrive at a port. Who pays the tax? It's the importer. Those are American companies. They just raised trade taxes, right? Then it's either thinner margins or it's passed along. What very enterprising individuals who are on television talk about today is, well, what about the Japanese? The Japanese are engaged in invoice pricing, right? They're cutting the price before it's shipped, but then there's still a tax attached to that, right? They're going to have their cake and eat it too, because right now we've really only seen inflation in the consumer product sector, toys, apparel, appliances, audiovisual equipment. We have yet to see the tariffs put on Mexico or the or Canada really begin to show up in terms of the food supply chain and the manufacturing supply chain. So today's the 17th of August. I don't know about you guys. It means in 14 days, we're going to get to the 31st. We'll have a pretty big decision, see if Trump's instincts serve him well and he backs off again, or they follow through and we have much higher taxes on imports from Canada and Mexico, in which in short time you're going to see inflation show up on those products.
Caleb,
Moreover, the Trump administration won't have much of an argument to stand on anymore after that.
Caleb, on that date on the calendar that Joe put on there, it seems like the markets have been betting here that yes, Trump believes in tariffs as a policy tool, and he is going to impose tariffs, but he also believes in his legacy, and he doesn't want to upset the economy, he doesn't want to upset the stock market, and he's going to try to thread that needle. And the market's, I guess, taking a bet here, Caleb, that he'll be able to thread that needle. But what do you make of it?
Well, maybe they're just looking beyond the fact that maybe these do go into place, maybe they don't August 1st, and maybe they don't go into effect to the extent that they've been threatened. While Joe was mentioning tariffs, he didn't mention copper, but he knows that copper is a very big deal here. Dr. Copper runs things around here when it comes to industrial production, when it comes to electronic manufacturing, when it comes to just about every industry. And those tariffs going into effect August 1st, 50% on copper, that's going to weigh across all industries. And yes, we may get a pullback on that. That might just be a line in the sand that the Trump administration pulls back from eventually, like so many they've done so far. But if that does go into effect, that could seriously rattle the economy for a long period of time.
Joe, Alexis, thank you both so much for your time today. Appreciate it.
Thank you.
We are just getting started here on Market Domination. Coming up, the House of Representatives appear poised to pass key crypto legislation. We're going to hear from one of the reps voting on that bill on the other side. Plus, Uber is betting big on robo-taxis with pure-play electric vehicle maker Lucid as its partner. We'll dive into the details later in the hour. And retail sales rebound in June. So what's that mean for the likes of Nike and Lululemon? We're going to break down how to be positioned within this sector in today's Investor Playbook. Stick around. Much more Market Domination still to come. Crypto Week is back on track with the House working on delivering a clear pro-innovation framework for digital assets. Crypto stocks getting a boost this week amid optimism over legislation. Here to talk more about this, we've got Caleb. Let's talk about crypto and Investopedia. Over at Investopedia, are they excited about crypto? Not excited? How do they feel?
Yeah, I think about, 20% of our readers are into it in some form or another, whether it's through the Bitcoin ETFs or whether they own the coins outright. But price drives interest, and it drives interest in just about every asset class. Bitcoin is very unique because it's so shiny still, and the gains have been so impressive. So the higher the price goes, the more people are interested in it. You get a big collapse there, people are interested in that as well. But we always get this question over and over from those that have not invested in it yet. Should I? Is it too late? Is the price too high? And who knows? But all we know is this institutional adoption is for real. The legislation pathway is being cleared. Green lights all the way for crypto. I'm not saying prices necessarily go higher, but the fact is the government is basically opening the doors to put crypto into our financial lives in many different ways.
In terms of the recent move in Bitcoin, Caleb, I've been talking to folks on the show, and some of them, and I asked them explain this move to me, the recent move, and they'll say, well, don't overthink it. It's just strong corporate and institutional demand and limited supply. So yes, the price is going up. It's simple. Is it that simple? Does that explain what we're seeing?
Yeah, more buyers than sellers.
Right.
That drives the price up. But think about what's actually happening here. Both the Stablecoin Act, the Genius Act that probably get passed this week. This opens the door for now stablecoins in our banking system, things to bank Bitcoin against. You can now use Bitcoin to get a loan if you want. Use your Bitcoin as collateral. You can buy a home with Bitcoin. But you know who's been buying a lot of Bitcoin? The biggest asset managers on the planet. BlackRock now has some $78 billion worth of Bitcoin, and a lot of the other asset managers are piling into it as well. They want to have their piece of it because of that limited supply and because of the big institutional adoption. It'll be in our 401ks in a minute here.
We were talking off camera. You own Bitcoin. Got in years ago. Why did you decide to get in?
I wanted to understand this ecosystem. You have to own the asset to understand it. I believe that. Know what you own, and I wanted to understand it. So I did some research on the white papers, and I'm not a technological genius. I'm an art major. That said, I'm a long-term investor, and I took a look and I noticed how many people were acquiring it. And it's something that I believe would be here 10 years from when I started buying it. I also believe it'll be around 10 years from now. I want to own those assets. Now, it's a small piece of my portfolio, along with some other tokens and coins, because I want to know that ecosystem. I want to know how they operate. And to be honest with you, it's been pretty beneficial. It's been a little bit of a volatility cooler in some cases, and sometimes an accelerant when other parts of the market weren't working.
What you mentioned other tokens and coins, what others interest you?
Yeah, Ether interests me. ETH interests me because it's actually smart. You can do things with it. Bitcoin's getting a little bit smarter, but it's always been the slower, slightly dumber coin. No offense, Satoshi. But Ether, you can actually do things with it. You can transact with it as well. And I wanted to own a couple of the stable coins as well, just to see how that relationship works when it's pegged to a fiat currency like the dollar. But I'm not going to go overboard with it. It's a small percentage of my portfolio, but I'm consistently adding to it, like the rest of it, dollar cost averaging in every single month, just a little bit of money, just to make sure I keep buying it at whatever level it's at, so I continue to own it going forward.
Yeah, you're consistently at dollar cost averaging, and you're looking pretty smart, Caleb. You're pretty smart.
Me and 50 million other people, I guess, but I'm not smart enough to buy a big chunk of it back in 2009.
All right, thank you, Caleb. All right, now time for some of today's trending tickers. We're checking in on shares of Taiwan Semiconductor, Oracle, and Elevance Health. First up, check out TSMC getting a boost today after topping earnings estimates and raising its outlook for 2025 revenue growth. The company now forecasting sales growth of about 30%. That is up from mid 20% previously. Caleb, what do you make of it?
Yeah, I mean, chips are back and they're hot, and NVIDIA's record highs and the $4 trillion market cap mark, that's got a lot of people interested in this space again. But there's also deals being cut right now with China and US chip makers, NVIDIA being case in point there. So as that stock goes, a lot of stocks go with it. But Taiwan Semiconductor is a giant. Yeah. It's the biggest chip maker on the planet, and the demand for chips is insatiable. As long as relations are okay, and it looks like we're getting to some sort of a better ground in terms of those tariff negotiations with China, you'll see chip stocks continue to outperform. And they've been through a lot over the last couple of years. They were the hot sector, but I think they're back in style right now because it looks like tensions are cooling.
Yeah, it's over at TD Cowen. They have a hold on this one, telling clients AI cloud fueling, they say 2025's 30% revenue expansion. They talk about how AI could drive greater silicon use in PC and mobile devices. They did call out on this one, tariff impact to demand remains a risk later this year. Helps explain why they're on the sidelines. All right, moving on. Oracle, let's look at that one. Shares higher after receiving a sector outperform rating and a street high $300 price target over at Scotiabank, which sees strong growth potential for the software company's cloud computing business. So street high $300, Caleb. They say here we see Oracle transitioning into a new paradigm, reinventing itself, they say, as a tier one independent AI infrastructure provider. Yes. I mean, look at the chart. You can see the stock has enjoyed a big run, but we believe they told their clients Oracle remains underowned by long onlys. See opportunity for shares to rise further as Oracle outperforms expectations. So bullish on Mr. Larry Ellison.
Yeah, and Oracle is one of those super scalers, they call them out there, that's spending a lot of money to build out its AI infrastructure, build out its cloud computing capabilities, and offer those services and support to other companies. And it is a slight pivot for a company that was really not about that 5-10 years ago. You never would have said those words in the same sentence, but this company's been out in front of a lot of things, and I think it's benefiting from that. Any company that's doing some heavy spending on building the infrastructure, because for these big mega cap companies, it's a zero-sum game, the AI game. They want to own as much of it as possible. So as long as they keep spending and developing it and offering and selling those services out to other big companies, they're going to be fine.
Yeah, Larry Ellison, software cats, winning over a lot of new fans on the street. Lastly, shares of Elevance Health sinking after it cut its profit guidance for the year amid higher medical costs in the Affordable Care Act plans. The company also posted a miss for earnings per share. So cut the profit guidance, Caleb. Reports noting higher medical costs and Affordable Care Act plans, lagging reimbursement from Medicaid. I mean, the health insurers broadly not been delivering us great news. And look at the stock on that one, down hard.
Yeah, no, and when you cut your outlook or don't provide an outlook, you're going to expect your stock to get crushed like it's been crushed today, down 12 or so %. But what's important to watch with providers like this is the benefit expense ratio. How high is that expense ratio climbing in terms of the payouts they have to make? It was at 88.9%. That's up 2.6% year over year. Doesn't sound like a lot, but when that's your biggest expense and that's weighing on you, that's going to weigh on your stock, and investors see right through that.
Yeah, I see analysts at Vital Knowledge, cited at Bloomberg, is saying managed care, they say, probably become the most hated sector in the whole market right now, they say, given rising medical costs, the intense pressure in various government programs. They go on to say not much reason for people to buy the dip.
Yeah, and they are going to be under pressure because we know through the great big beautiful tax bill or whatever it's called, that we know some of those social services are going to be cut. That means higher expenses for a lot of these providers as well. So they're going to be probably front and center of that with a lot of other companies that are facing trouble. United Health, one of the biggest healthcare providers in the country. They have other issues, other headline issues. They're going to face these problems as well.
Yeah, rough day for Elevance Health. All right, coming up, Uber betting big on robo-taxis with pure play electric vehicle maker Lucid as its partner. We're going to get you on the details on the other side. Stick around, much more market domination still to come. Uber and Lucid partner up as they set off on a journey into the robo-taxi space. Let's get to Yahoo Finance's Praz Subramanian with a closer look. Praz.
Hey, Josh. Yeah, so big bet here by Uber on robo-taxis, this time with partnering with Lucid to buy 20,000 Lucid Gravity SUVs in the next 6 years. They're going to use a company called Nuro to power the actual level 4 autonomous OS of these vehicles, and they're going to deploy it on the Uber network exclusively, right? So they're going to start next year in a major American city. As part of the deal, Uber will invest $300 million into Lucid, so you're seeing the stock of Lucid pop here on that news, and also Nuro getting a multi-$100 million investment too. So yeah, I mean, it's a return to the robotaxi space for Uber. You know, many years ago, Josh, you probably remember when they had a very serious incident in Arizona where a pedestrian was killed. They pulled out of that business altogether, and now they're dipping their toes back in, but this time with strategic partners like Lucid and Nuro here, and looking to get back in the game and potentially take on Waymo, who's sort of the runaway leader right now, and Tesla, which is getting ramped up in Austin as we speak.
What interested me about this, Praz, was the fact that Uber decides to partner with a Lucid. I mean, Lucid, you don't think cheap when you think Lucid. I mean, Lucid's entry-level Gravity starts near $80,000, Praz. So that was my question. Like, Uber's CEO, Dara Khosrowshahi, why partner with such a high-end luxury brand? And does that ultimately, how does he make that work? Does that make good business sense? Dara, obviously very smart guy, very successful, but I'm curious how you're thinking about it.
There's two thoughts here, right? So even with Waymo, for instance, they partnered with Jaguar with the I-Pace, I believe it's called. That was actually a higher end EV, and I think Waymo used Volvo too. So there's precedent there using more luxurious cars in the space to kind of maybe give you maybe separate the experience and make it a bit more higher end. But I think, Josh, there's a little wrinkle here. Saudi Arabia's PIF is the biggest investor in both Uber. Sorry, let me rephrase that. The PIF two biggest investments are Uber and Lucid in that order, right? So maybe they were behind potentially saying, hey, can you guys merge together, potentially work on something together? You know, obviously PIF is the majority shareholder in Lucid, right? So I think there might be something there with the money, but I also agree that sometimes you might want to use a more higher end vehicle in one of these more experimental testing to kind of give the user a higher end experience.
Yeah. And it's also about range too, right? The Lucid has a much wider range and farther range than other EVs for 450 miles, I believe, on the charge. That's going to be important for robo-taxis in the future. Not going to be a lot of chances to stop and plug in for those vehicles. So you got to think that has something to do with it as well.
Yeah, I mean, Lucid known as very efficient drivetrain, very efficient batteries. They're one of the top in the game in terms of just their technology and software stack, if you want to call it. Almost probably nearly double the Jaguar I-Pace in terms of range, so that probably is weighed in that as like another element of maintaining a vehicle, keeping it on the roads longer, maybe lowering down that cost per mile, I would imagine, for robo-taxis.
Praz, I'm just curious, how do you think this news potentially kind of just ripples through the broader competitive market here? How do you think a Tesla thinks about this? What do you think a Waymo's reaction is?
Yeah, I think big picture from a competitor point of view, you kind of like to see more competitors in the space. Yes, it might make things a little bit more difficult, but it shows there's more money coming in, more technology, more investment. I mean, like I mentioned, the PIF has a ton of money to put in the space. I think it helps push the whole industry forward. And the way I look at it, Josh, is, you know, a few years ago, everything was about EVs, right? EVs were the big mover in the automotive mobility space, and now we're pivoting over to robotaxis. EVs combined with software, embodied AI. It's the next big exciting thing in the transportation mobility space, and I think another entrant is a good thing. I think it helps get more data, get more people on the road, get more people. One of the big hesitancies is users don't want to go into these vehicles with no operator. I think the more competitors in the space, the more cities you have on offer, the more that becomes more acceptable to the broader public.
All right, Praz, thank you. Appreciate it.
Thank you.
Well, Novartis reporting strong second quarter revenue growth driven by continued demand for key drugs. The Swiss drug maker also boosting its full year profit outlook, and Yahoo Finance's Julie Hyman got the chance to speak with the CEO of Novartis for a closer look on the quarter and what's driving an optimistic outlook. Take a listen.
We have these launches really performing at a high level. Our existing brands are continuing to show dynamic growth. And then our productivity programs are allowing us to raise that bottom line guidance. It's our 10th bottom or top line raise in the last 10 quarters in a row. So I think that really shows the consistency of the operating performance.
One of the things I saw some analysts talk about in the quarter, which may be why the shares are under a little pressure, was sales of Cosentyx, which is your psoriasis medication, a little bit weaker than estimated. You talked on the call a little bit about maybe seeing some weaker demand out of China. Can you give us some more details on that and how sustained you think that's going to be?
Yeah, I think with Cosentyx, it's kind of a short-term, long-term story. In the long run, we're absolutely confident we'll get to our $8 billion peak sales and can consistently deliver mid-single-digit growth. We have seen a period of time over the last 4 or 5 quarters where Cosentyx has performed really well, and that's been driven by 2 things. One is performance in China, and 2, a new launch of a new indication in a type of dermatologic disease, hidradenitis suppurativa, which was really driving the performance over the last year. What we've seen in China is a slowdown, I think sector-wide. There's just more cost containment right now in China with respect to healthcare, and that led to slower growth in China than we've had in recent quarters for Cosentyx. And then in the US, we've had more rebates as part of the normal mix of things that happens in the US with Medicaid and some of the other discount programs, as well as a new competitive entrant came in this HS indication. But, I think this is a short-term topic. I think we're going to have Cosentyx continue to grow this year, and we'll be back on track to get to that $8 billion outlook. And I think it just demonstrates that Cosentyx has been so consistent now for over a decade. This is just what investors expect, and we'll get back to that soon.
Gotcha. Let's talk tariffs a little bit, because earlier you did say, you told journalists that the new tariffs will not affect your guidance. Can you give us a little bit more details on that, kind of what your manufacturing footprint looks like for those who are not familiar and how you're navigating that?
Yeah, absolutely. So for this year, because normally we carry 6 months of inventory for all of our key medicines, we have adequate inventory in the U.S. prior to any of the tariffs being enacted, that we don't expect that the tariffs have any impact on our guidance for 2025. And then for the medium term, our goal is through a $23 billion investment plan to build manufacturing capacity in the U.S. for all of our key medicines. We do make a few of our key medicines here in the U.S., but we need to expand that footprint so that all of our key medicines are produced in the U.S. for the U.S. We're expecting to be able to complete that in the next 3 to 4 years. We've already signed leases for new research sites, broke ground on 1 new manufacturing site with more to come. So we feel like we're on the right track, but that's going to be really critical because we know the administration is quite focused on pausing tariffs, at least that's what we expect, if you demonstrate you're actually actively moving that production into the U.S., and that's what we're planning to do.
Oh, that's interesting, boss, because, obviously we've gotten sort of vague indications from the president. He has mentioned a 200% tariff on pharmaceuticals, but he's also talked about maybe a 1-year phase-in period. But are you, as much as anybody can be confident of anything when it comes to tariffs, what's your confidence level that you will have a little bit more time before something that onerous would be imposed?
So I can't really predict, I have to say, as you know, it's very difficult to know. But that said, I think we're confident that as long as we're demonstrating progress, hopefully we can manage the imposition of these tariffs. We need about at least 3 years, but probably closer to 4 years to really move production fully over. So we're hopeful the administration sees that. And as long as we can demonstrate concrete milestones in terms of building out that capacity, that gives the confidence that we're serious about this and we will get there. But you're right, we'll have to see. We haven't seen the exact policy. We don't know exactly what the expectations will be, and we'll have to navigate it once we see that.
And Voss, you'll be navigating it without your longtime finance chief. Harry Kirsch is going to retire in March of next year. He's been with the company for 12 years. Do you foresee any kind of impact that that's going to have on your this leadership change on your financial strategy, especially since you're going to be navigating some of these tariff headwinds?
No, not at all. I mean, I think this will just be a great opportunity for continuity, if anything, at Novartis. Harry will, at that point in time, have been CFO for 13 years. And I think that's a normal time point for someone to want to perhaps pursue a next chapter, new opportunities. So this is part of, I think, a very structured process. We have an 8 to 9 month now handover. Harry's successor, Mukul Mehta, has been with Novartis since 2003, knows the company extremely well, intimately aware of our strategy and our financial approach, capital allocation, et cetera. So I think this will just be more of a continuation of where we've been financially, a very balanced approach to capital allocation. We invest in our core business. We have a strong and growing dividend in Swiss francs. We do BD&L and M&A as appropriate when there's attractive things happening, and then we do share buybacks. And today we announced another $10 billion share buyback, having just completed a $15 billion share buyback earlier this year.
Right, definitely good to mention that. Finally, I want to ask about Ernesto, your top-selling heart drug, which is facing patent expiration. And I know you've talked a little bit about some legal challenges to that expiration in the United States. What more can you tell us about that and how you're incorporating that into your forecasts?
Yeah, absolutely. So we had always guided that Entresto would go off patent or have a generic competitor in the middle of this year. So that's the basis of our 2025 guidance, as well as our midterm guidance of a 5% plus growth out to the end of the decade. So that's all baked in. Now we do have a temporary injunction against the lone generic player who we don't have a settlement with, and that's being played out in the courts. And so any additional month we get would lead to $300 million or more of additional sales and profit for the company. But we guide based on the expectation that the generic could launch at any point in time. And we'll have to just see how the court cases play out. But we're absolutely comfortable with both our 2025 and midterm guidance, independent of what happens now with Entresto. So anything we get now is an upside.
Coming up, retail sales rebounded in June, so what that means for the likes of Nike and Lululemon. We're going to break down how to be positioned within that sector in today's Investor Playbook. Stick around. Much more market domination. That's still to come. Retail sales coming in stronger than expected on Thursday, signaling a continued resilience in the consumer. But with tariff uncertainty and trade deals on the shelf, it may be time for investors to rethink the space. We're navigating how to play the retail sector with the Yahoo Finance playbook. Joining us now is Simeon Siegel, Managing Director at BMO Capital Markets. Simeon, it is great to see you as always on the show. So, Simeon, we're always looking for lines of sight into the consumer. Retail sales, we got that data point today, rose more than expected in June. You have line of sight there too, Simeon. Given your coverage universe, I'm just curious, what are you seeing? What are you hearing about the American consumer, Simeon? How healthy, how resilient?
Good to see you, Josh. Line of sight, magical thing. Wouldn't it be nice? Listen, I think that what's so important, retail sales versus consumer sentiment seems to be this important distinction that we need to make, and we're learning. Yeah, people are buying things. And so they're not buying willy-nilly, they're not buying without abandon, but they are buying things if you give them a reason. So we're seeing market share conversations. So my view, from what I can see about the consumer, healthy or not, the U.S. consumer is overly resilient. You and I always talk about that. And what we're seeing even in the most discretionary of categories, even in the companies that I tend to look at, there are companies that are gaining sales. There are companies that are doing it, and they're doing it at higher profits.
Let's talk tariffs as well, Simeon. I'm curious, what kind of tariff-related margin pressure, Simeon, do you expect to see in your coverage universe?
So listen, I think the interesting thing that we have to acknowledge, tariffs raise the cost of goods. They don't raise the price of goods. I think we all wanted to believe that with tariffs come immediate price hikes. It's just not true because in discretionary retail, right? Because the consumers need to accept those prices. And if you demanded 20% off for a pair of jeans last week, I promise you're not going to all of a sudden say, okay, I'm willing to pay full price because of tariffs. So what we're seeing with tariffs listen, you have three different options. Either you can price it along, because the easiest way to mitigate a tariff is to raise price. The problem is it's very hard to raise price. So you're seeing certain companies raise price, and by the way, do it surgically. Nike is raising price on certain shoes, but not on others. The alternative is to say, okay, I can't raise price, or I can, but let me find a way to save elsewhere. So let me cut costs. Let me actually take margin savings that I would have otherwise told you about, and now feed them into tariffs. And then the third option is you have to absorb it. And we're going to see all three, right? It depends on where you are, because what we are seeing right now is obviously companies are going to have to entertain tariffs. Now, I do still think that the biggest problem with tariffs is more so the uncertainty of them than the severity of them. They're pretty severe, but all the companies I talk to, they know exactly what they're going to do when they're told what the tariff is going to be, but they're not sure which plan they're supposed to put in force. And I think that uncertainty has been a big problem.
Simeon, where should retailers be making product? We know where the president wants to make the product. He wants to make it here. Should it be here? Is it Asia? Is it Latin America, Africa? Where's the smart place to make the product?
So at the risk of upsetting the political sphere here, where should they make product? The place where it's most economical, right? It's as simple as that. Finding out where is most economic is going to be the hard question. And so that's this point. I've been talking to a lot of companies that will say, okay, am I supposed to pivot? So in the last 10 years, the playbook was pivot out of China, go to Vietnam. Well, obviously, that's not such a great answer right now. So now people talking about Mexico. Well, then that pivots. Then it's Brazil. Then it's for the product that you and I want to buy at a reasonable price, you need to find a place that's going to be able to do it at a cost that you're going to be able to sell it at. And so that is this dance that people are trying to figure out. Once they know where these costs finally settle in, people then have to recalibrate. The companies will have to then move around their manufacturing and figure out where can I do it to get the best quality at the best price, because it's not just the best price. You still need it to be quality. And that's this dance. And so I don't think there's an answer right now that people can say, I know exactly what country I'm supposed to move to. And I think that's what makes it so difficult.
So the dance continues. Meanwhile, Simeon, you have to make recommendations to your clients. So let's get to some picks. Nike, you got the equivalent of a buy on that one. How come, Simeon?
I think, and you and I have talked about this in the past, I think with Nike, what we're looking at is the exact problem that they faced a decade ago. And so to your point about tariffs, Josh, I need to look at these businesses and say, if the easiest way to walk past a tariff is to be able to raise price, then all that means is I need a company that's able to raise price in general, which means I need a company that has brand equity. Nike has brand equity. And so this thing, my team did a really fascinating report, and I'm appreciative of them for it. But we looked back a decade ago when Adidas started taking mind share from Nike with the Ultra Boost, with the Yeezys, with the Gazelles, with the Sambas, with all of these things. What Nike did, they went back to their archives, they flooded the market with Jordans, which is exactly what happened now. And then they came out with a competing rhyming product to that Ultra Boost. It was called the Epic React. Right now, Nike's been dealing with the same issue. They watched Hoka and On and New Balance and all these brands that had created a big max cushion that's product that Nike didn't have take mind share. What did Nike do? They went back to their archive. They flooded with Jordans, with Dunks. Like this was the same thing that happened, but they needed a competing product. They didn't have it, and now they do. And so as of the last earnings call, Elliott Hill, the CEO, talked about this new line, the Vomero 18s, did 100 million, 90 days. That's a good start. And so do I think we're out of the woods? Certainly not. Does it look like we're troughing earnings? That's what it looks like. And if that's the case, then people start cycling into Nike's earnings power. And so I think Nike, you have this big business that's obviously very ownable that becomes really interesting. I think on the other hand, there's some companies that are a little bit smaller that really are lying in the dirt from an investor valuation perspective that look interesting. I think that Capri, which owns Michael Kors, just sold Versace or is in process of selling Versace and owns Jimmy Choo, is a company that had a very dirty looking balance sheet, but with the sale of Versace will look very clean. The multiple doesn't reflect it. So I would look there. I think a Bath & Body Works, which is finally, as ironic as it sounds, seemed to be finally cycling through a Peloton overhang, a pandemic overhang, like we saw with Peloton, like we saw with grills, like we saw with home patio furniture, where people overbought things during the pandemic. People overbought candles, they overbought soaps and sanitizers. It lasts a while, but as of last quarter, you watched revenues grow. You're starting to see that change. Look at the free cash flow yield. It's not reflected in the stock. So different types of stories. These are a little bit more, you have to go down and dirty and look for value. But I think there's interesting dynamics here across the market, where on the other hand, I have plenty of stocks that are trading at their all-time highs.
I only have about a minute left, Simeon, but I want to get this one in. Here's a name where you don't see value. There's only one sell, I think, Simeon, in your coverage universe. That would be Ralph Lauren. How come?
Listen, I think Ralph has done a great job. Ralph is one of the ones that I referenced as trading at their all-time highs. The problem is you're looking at Ralph Lauren, the person selling stock. You're looking at Ralph Lauren, the family sold stock in the last year. You're looking at some management that left, and you're looking at a business that right now, again, like I have to look at stocks, and I have to be cognizant of the fact that this has run a lot. And so I think when I look at Ralph, it's hard for me to be recommending that, especially when I acknowledge that you're watching some human signals that are hard to ignore.
Simeon, always great to see you. Appreciate your time, your picks, sir. Thank you.
Good to see you.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings results from Netflix. Stay tuned for Market Domination Overtime.